So what we are going to do, we are going to first learn how to hedge the currency risk, and then we are going to stock market and interest rate and commodities. We'll just go in that order, okay? And more focus will be on currency and stock markets, and then less on interest and further less on commodities, okay? Fine. So how do we hedge currency risk? Okay. So hedging currency risk is a way for a company to minimize or eliminate foreign exchange risk. Basically what the companies do, they want to eliminate because they are exposed to currency risk, because I have to make payment in dollars or pounds or yens, okay. So I have to make it, say, after some time, and the currency may appreciate or depreciate, and it can go in my favor or go against my own wishes. So I can either lose or make gains. But business people, they are just generally more focused towards their business, and sometimes they don't want a gain or a loss, okay. So they need to hedge, okay. Of course you cannot make also gain also if you go for options, okay. So we'll learn all that. So internal techniques, though, there are ways in which we can manage our currency risk. One is internal techniques within the business itself, and today for most of the lecture, half of the lecture, we are focused going to the internal techniques, which are without going to any third party, taking a forward contract or going to options or future and options market. We can even do ourselves also. So external techniques involving a third party. That means you go to a bank or you go to a stock exchange or a financial institutions and take cover, okay. So hedging currency risk. So there are a lot of ways, okay, like forwards, futures. So you can enter into a forward contract with the bank, fine, and book a rate today. So you have to make a payment after some time. So they'll give you a rate and you book that rate, okay. At that you're going to make a payment, irrespective where the market is going, okay. So you can protect yourself. But the downside is that if the currency goes in your favor, okay, still you have to pay at a price which has been fixed. So you will not be able to gain the opportunity. Similarly in futures also the same thing, but it is done through stock exchange, fine. So there are difference between forward and contracts. Number one is done by going to a financial institution or a bank. The second is that you go to a stock exchange, okay. Now in futures contract, you manage the same currency risk by going to the stock market, okay. Now any other difference which you can think about in futures?
Mark to market, you have to pay the market every day at the end of the day.
So that means there is no third party risk, okay. So there is no counterparty risk. So the stock exchange ensures that the transactions will sail through a mechanism which is called mark to market or by collecting margins, okay, fine. Whereas in forward contract there is no such thing. Normally you deal with banks and banks don't back out, so there is no counterparty risk there also, but it can be, okay. So what else in futures contract? Are they you get dollars from there or pounds from there? I mean, suppose you are hedging yourself, you don't get any delivery. It is not a delivery based a kind of a hedging technique where you buy a dollar from someone to the stock exchange. He is not going to deliver dollars. You are going to they are only cash settled. You have to still buy your dollars from the cash market, okay, but you either make a gain or loss and you hedge yourself in that process. In futures contract. In futures contracts they are cash settled, whereas in forward market they are delivery settled. Do you understand that?
Yes, you have to give the delivery in forward.
Forward, yeah. So either you take a delivery or you give delivery. So that means if you are an importer, you take delivery, and if you are an exporter, you give delivery and convert your dollars into cash. If you are an importer, you have to take the delivery and pay money for making a payment to an importer. But in case of a futures contract, there is no delivery. So if you have ordered dollars through the stock exchange, you're not going to get dollars from the stock exchange. Okay, so you have to still buy the dollars in the cash market. Okay, so how do you protect yourself? Yeah, what's your name? I just forgot. हाँ? विशाखा. कैसे फिर अगर आपको डॉलर्स नहीं मिले तो आप कैसे प्रोटेक्ट करोगे अपने आप को? So what is the mechanism? The mechanism is that if you have bought dollars, say at a certain amount, say 85, and it goes to 86, you're an importer, okay, you have to make a payment at 86 in the cash market to get your dollars. But you're going to get 1 rupee from the stock exchange because you have taken a position at 85 and dollar has gone up to 86. So you'll make 1 rupee from the stock market and 1 rupee you pay extra in the cash market. That means you're still paying 85. Is that okay? Fine. Is that clear?
Because of mark to market.
No, mark to market is just a mechanism.
Okay.
It's a mechanism to protect both the buyer and seller. They can't back out of the transaction. Just that is the only purpose. Market से कोई hedging नहीं होती है. Okay, like suppose if I enter a transaction with you and you back out. So you can't back out because you have to deposit a margin, and the stock exchange is going to collect money every day on the basis of either making a gain or loss. So that at least from my side, I'm protected. Okay. What's your name?
Shubham Singh, sir.
Shubham Singh. Okay. Have you followed that?
Yeah.
Forward and futures. So then we have options. Here, the best part is that here you have a right. Okay. To you will get the dollars. But here you have a right, but not you have, it's optional on you basically. Okay. If you want to exercise a right, it's okay. Otherwise, you can get other transaction. Fine. Suppose you bought dollars at 85 and you are an importer. Now, if it goes to 86, 87 you are making, so you are going to exercise your right and get your dollars at 85 at the price at which you have booked the dollars. But suppose it goes to 80, then you can just simply walk out of the contract because you can buy from the cash market. Otherwise, also you are buying from the cash market and you can just lose the premium which you have paid to the option writer. Okay, so you lose only the ticket, the premium. Like it's like watching a movie. For example, you booked your ticket for going for a movie next week. Okay, so you booked a ticket and you spent about 1,000 rupees on 2 tickets. Okay, whatever amount. So somebody told that it's not a good movie, so please don't go and watch. So on that day you decide not to go and watch. So only thing you are going to lose is $1,000. You have a right to exercise your option and go and watch the movie if it is good. Otherwise, if the movie is not good, if the reviews are not good, you can just lose that $1,000. Okay, unless you sell it to someone. Otherwise, you lose it. Okay, or you give it to someone, you are going to lose that money from your pocket, isn't it? So in options, you can make a gain also. If you're sitting on a gain, you don't exercise it. Okay, if your dollar has come down, so you don't exercise the option because only if the dollar goes up, you are going to exercise your option. Is that okay? Is that clear? Currency swap, so which we are going to learn in my coming slides. Okay, through a practical example. Okay, then natural hedging, so which also we are going to understand right this thing. I'm going to explain that, okay, just in a short while. Money market hedge, which also I'm going to share. Diversification. That means, again, here basically you are not exposed to one currency, you are exposed to many currencies. Okay. For example, just to give a flavor here, like a dollar and yen, they are not correlated to each other. If the dollar goes up, yen falls, normally. Of course, they can always move in tandem, but there is hardly any correlation between dollar, but there is a strong correlation between dollar and euro. Okay. So if you have, if you have diversified your exposure in dollars and yens, then the chances are that you may be gaining from somewhere and losing from something, and your net will be nothing. Suppose you are an importer or an exporter in the two currencies, so you have diversified your exposure to multiple currencies. I'm going to give it through example also that explain. So here you can diversify instead of being exposed to only one currency, you are exposed to many currencies and choose those currencies more which are not directly correlated to each other. Have you done what is correlation?
Yes.
Correlation hovers from which number to which number?
0 to 1.
-1, 0 to 1. Is that? Are you aware of that? No. So just to give an idea, there's a very important theory which came in the world, which was called the modern portfolio theory, which was developed by Harry Markowitz. Okay, he got the Nobel Prize for that in that era, and William Sharpe. So these are the various economists and financial guys. So they said that when you're investing your money and making a portfolio, your portfolio should be such that your assets are not correlated to each other. So you reduce your risk and you can maximize your profits. Suppose you're investing, for example, in two stocks, TCS and Infosys. Both are at the same this thing, so they are correlated to each other. If the stock market falls, both will likely to fall at the same time. Similarly, for example, if you're buying gold and stocks, they are having a negative correlationship. Like mine, I would say -1. Okay, that means if the gold goes up, the stock market falls at that time because there's an uncertainty in the economic situation and people are latching towards the safe haven, which is the gold, and they don't buy, they sell equities and buy gold. So they have a negative correlation. Similarly, if the markets are doing fine, economy is doing fine, people latch on to the stock market, invest into risky assets and sell gold. So they are inversely related. So it's a -1 there. For equity like Infosys and TCS, maybe somewhere near to the +1. So the stocks will always be there should be always be a negative. If your relationship is not so great, then always you actually maximize your profit and reduces your risk. In both the times you make money. When the markets are falling, you're heavily invested in gold, you're going to invest, or in a real estate, because all these assets are not correlated to each other. So this was the theory, portfolio theory, which was based on that. And here basically when you're buying, when you're exposed to a couple of currencies which have no correlations, then it is always better. Then operational hedging. Okay. Here also we are going to learn through an example, like case of example like Toyota Motors, which has many companies in the world in past, they were manufacturing cars in their domestic market and selling abroad. Okay. So that means they have to sell abroad, so they are getting, suppose they are getting dollars, and I am manufacturing those cars in Japan, and I am spending all the money in Japanese yen. Okay. If the Japanese one appreciates, then what happens? I lose money, because when I get money from abroad, I'll get less yen. Okay. But I'm incurring my cost in yen and I'm getting less money. So what the Toyota did was they are present now in 170 countries and they have plants all over the world. So they have done an operational hedging by having plant locations everywhere, where they manufacture the cars in America and incur their cost in America in US dollars. So they are not affected by the yen appreciation or the home currency appreciation. So we'll learn through examples. Okay. So let's go to natural hedging first. So forward futures we are going to touch at the last. Forward futures, options and currency swaps, natural hedging, money market hedge, diversification. This is the way we are going to do.
I guess Harshit might have sent you one link for joining online.
Okay. Done? Okay, can you hear me now? Is my voice audible? अच्छा, आपने भी कर दिया, इनको admit कर दिया. Who has admitted them? अच्छा, you've done. ठीक है. So we have Harshit and Shubham Singh MBA. Okay, fine. So let's go back to the lecture. My voice is audible to everyone in the online? Okay.
Maybe you need to shade up your screen.
हाँ वही मैं I was just checking with. हाँ वही कर रहा हूँ. So can you see my screen now? It's visible. Okay. So again to recap for the students who join online, so we are doing hedging currency risk, and so I told that there are two kinds of techniques, internal techniques within the business itself. So you hedge yourself without going to a bank or a stock exchange. Okay, do it yourself through your business initiatives. And then is the external techniques. That means you take a forward futures and options this thing. So these are the various kinds of mechanisms through which you can do your hedging. So there are external techniques like forward futures, options and money market hedge. So these are all external, whereas currency swap, natural hedging, diversification and operational hedging are all internal techniques. So first we are going to talk about the natural hedging, and then we move on to the external hedging. So natural hedging. Okay, so natural hedging is a risk management strategy where a company matches revenues and expenses in the same currency to reduce the need for currency conversion. So that means you don't need to convert the currency. So what you're doing, you're having your revenues and expenses in the same currency. Like I gave an example of Toyota, which has manufacturing facilities all over the world. Okay, so this minimizes the impact of exchange rate fluctuations on the company's financial performance. Like a Toyota's leverages natural hedging by producing vehicles in the same regions where it sells them. This helps Toyota offset currency risk without relying solely on financial instruments like forward or options. So since they have their facilities in the country where they are manufacturing and selling, so they have a lot of advantages because of that, and we're going to understand that. So how natural hedging works, the approach of Toyota. Toyota manufactures vehicles in key markets such as US, Europe and China instead of exporting cars from Japan. Okay? Whereas many manufacturers, they do manufacture in their own country and then they export out. So revenue earned in US dollars or euros is used to pay the cost, that is salaries, materials, operations in the same currency. Okay? So reducing yen exposure, because yen was, had a lot of volatility. I'll just show you how it happened and it wrecked the Japanese economy. Since the Toyota's headquarters and much of its supply chain in Japan, it incurs significant expenses in Japanese yen. By producing cars locally, that means manufacturing in US or other countries, Toyota reduces the need to convert the overseas profit back to yen, avoiding exchange rate risk that could erode profits. If Toyota manufactures vehicles in US and sells them domestically, both revenue and expenses are in USD. This creates a natural hedge even if the USD weakens against the yen. The Toyota's US operations remains largely unaffected because the local costs are also in dollars. Now let's look at examples. So please be patient and just look, because they're all explained through examples. If you keep asking questions, you can ask your questions after the session is over a little bit, okay? So if you don't understand, because everything will get explained through a lot of examples which I put. Scenario 1, without natural hedging. Toyota produces 1 lakh cars in Japan and exports them to US. So this is, if they were manufacturing all the cars in US, in Japan. So revenue was 3 billion US dollars and expenses were 350 million yen, okay? If the yen strengthens against the dollar, for example, from 120 to 100, per USD, Toyota will receive fewer yen when converting revenue, reducing profits. So that means it's gone up, the yen has strengthened from 120 to 100, that means per dollar they are going to get 100 now as against 120 earlier. So over the time it has actually, the yen has strengthened, so that means you will get less yens per dollar and you're not going to be, your profits are going to come down. Now if you look at, the trajectory of Japanese yen over the last so many years, right, starting from 1960 or 1970, the yen was 357 per dollar. And then it came down to 238 in the next decade, and another decade it came to 145, to 101, to 92. So the yen has been strengthening against the dollar, okay? And this was done by design, by US and some cartel there. So there was something called a Plaza Accord, where, the US was not making enough, they were having some deficit, and Japan was sitting on an extreme, profitable position. So they tried to see that the US depreciates so that their exports become remunerative and the Japanese, exports were not as remunerative to Japan. So then, of course, over the last decade, we find that the Japanese, the dollar has been appreciating, okay, like from 108 to 146. So this is the trend over the last one decade. So yen has weakened in the last decade, otherwise it has been coming, the yen has been, strengthening against the dollar, okay. Now this is just the opposite of India. India started at dollar at say 5 rupees way back in 1950s, and it has come now close to about 85, 86, okay. So the Japanese has moved just the opposite. So there is a negative correlation between the Japanese US dollar currency pair versus the US dollar Indian. So that was, I tell you, if you do diversification, so if you're exposed to Japanese yen as well as the Indian dollar, then the chances are that you're not going to lose if you're well diversified. Of course, but the last decade has shown that correlation has been little bit dented, okay, fine. So scenario 2, with natural hedging. Toyota produces 1 lakh cars in US instead now. Revenue 3 billion USD, expenses 2.5 billion USD, because all money has been spent in US, not in Japan, okay. Since expenses and revenue are the same currency, Toyota avoids conversion losses even if the exchange rate shifts. Okay, so scenario 1, it was without hedging. So where the revenue was like $300 billion and exchange rate was 120, so this was converted into Japanese yen. So this was without, when Japan was manufacturing cars in their own home country, and the expenses was 3.5 billion. So they made a profit about 10 something. Okay, now as the exchange rate goes from 120 to 110, so they are going to lose money because of that. Okay, at the time when they were selling, and at the time the money was being realized, they found they lost heavily because the dollar has actually depreciated, or yen has strengthened. Now I have actually sent you some Excel sheets. Okay, so where I have given all with formulas, everything, and you can always play around and just check there. I'm not going to take you to the Excel sheets. Okay, so then the scenario 2 with hedge. Here the profits remain the same. Okay, because everything is manufactured and sold in USA, and they are earning in US dollars, and they are incurring expenses in US dollars, so the profits are not affected. Now as a project, I'll give you one project which will be done in a group. So all this information is now readily available. It was earlier not. So you are going to do a case study of, say, companies like Apple. How do they manage the foreign currency risk? Like how the Toyota has done, how the other companies in the world are doing it. Okay, and present that as a group. So I'm going to share that maybe in the coming week, the topic which we are going to work on as a group. So key benefits of Toyota natural hedging: reduce currency risk and operational stability. By keeping production and sales within the same region, Toyota minimizes the need to convert currencies, shielding profits from exchange rate volatility. So this is a natural hedging internal technique through which you can hedge your transaction. Fluctuations in yen have less impact on Toyota's overall earnings because the regional production balances out the currency exposure. For example, Toyota's US operations generate revenue and incur cost in USD, while European operations do the same in euro. So the manufacturing plants in Germany, so they are incurring the cost as well as they are earning the revenue in euros, like what they are doing for America. So they are not exposed to the yen going up and down. It doesn't affect their profitability. So competitive pricing, when the operations are stable, okay, so there is no need of shifting the prices, because like for example, since Toyota reduces the risk of currency fluctuations, it can maintain stable pricing in local markets, unlike competitors who import vehicles and face fluctuation of exchange rates. Because of the exchange rates going up and down, so they need to either temper with the price, isn't it, to remain profitable in the market. But Toyota has avoided that. Natural hedging is often cheaper than financial hedging, because when you take a forward contract, options contract, futures, you have to incur a lot of cost. Okay, so you avoid that. So derivatives are always expensive. So like forward contracts, as it uses operational strategies to mitigate risk. Is that okay? Now, real world example of Toyota again. Toyota has a major manufacturing plants in Texas, Kentucky and Indiana, producing vehicles like Toyota Camry, Tacoma and Tundra. By producing cars locally for North American market, Toyota reduces the need to export from Japan natural hedging exposure. In 2023, Toyota's US operation generated significant revenue in USD, insulating the company from the impact of strong yen. So this is how they have managed their currency risk. Combining natural and financial hedging. So they are doing both. This is the natural hedging by having operating from that country and spending in that country's currency, while natural hedging forms the backbone of Toyota's risk management strategy. It also supplements with financial instruments like forwards and swaps for additional protection. So we'll understand how they are managing that. Forward in our later slides. Forward contract used for hedging long-term yen exposure. So they are using forwards, futures as well as swaps. Cross-currency swaps helps Toyota manage liabilities in different currencies, aligning with global financing needs. And we are going to understand the cross-currency swaps also. Okay. Diversified supply chain. Toyota sources parts and materials from multiple countries, further spreading the currency risk. So this is diversification, because they are sourcing parts and material from multiple countries. So they are exposed to many other for inputs they are exporting from various countries and trying to use because when you having exposure in different currencies, just a single currency, you can protect yourself. Okay. Global manufacturing footprint. Toyota operates in over 170 countries, allowing it to strategically hedge against multiple currency risk through local production. So I'll just show you, the income statement of Toyota versus many other Japanese countries like Sony and Honda. So you'll find that the Toyota has shined among all these because other countries like Sony have become less profitable over the time. Okay, because they were mainly manufacturing in their home country. Balanced currency exposure. Toyota earns and spends a mix of currencies, balancing US dollars, euros and Japanese yen exposure across the region. Long-term protection. Natural hedging protects Toyota not just from short-term fluctuation but also from the structural shifts. As we have seen, there have been a lot of structural shifts that happened in the Japanese versus this thing over the years. So example of the structural shifts in USD Japanese. In 1985 to 1995, the yen appreciated sharply from $250 to $80 yen per dollar, following a Plaza Accord, an agreement to weaken dollar and strengthen other currencies. So at the bottom, in 1980s, the US dollar was overvalued, making the American exports expensive and less competitive in global markets. This contributed to large trade deficit in the US and significant trade surpluses in Japan and West Germany. The goal of the Plaza Accord was to correct these imbalances by reducing the value of the dollar. So this is what the certain countries, they became a part of it, and they operated this Plaza Accord to strengthen the Japanese yen. In 2008-2011, after the global financial crisis, which we witnessed, the yen strengthened to 76 yen per dollar as investors sought safe haven assets. Like, they moved on to basically to the gold and other assets, silver and other things. And so this has actually resulted in a kind of a strengthening of the US dollar versus this thing. So they were buying actually gold and they're incurring, there was a demand for dollar more, and so dollar had appreciated at that time. Normally that would happen. The yen depreciated, hitting 32 years low of 150 due to the divergent monetary policies between Japan and US. So this is how the currency has moved. Now, summary of Toyota's natural hedging strategy. Just read that. Can anybody आप पढ़ो थोड़ा सा एक बार.
Localized production, manufacture where sales occur, revenue and cost alignment, match expenses with revenue in the same currency, reduce conversion needs, minimize repatriation of profits to avoid unfavorable exchange rates, supplementary financial instruments, use financial hedging for long-term or excess exposure. This hybrid approach allows Toyota to navigate global market effectively, maintaining profitability even during volatile currency profits.
Yeah, they have been using both, the natural hedging as well as, the future and options and swaps. Yeah.
So in this case, they are manufacturing locally and selling locally only, right?
Yeah.
In case of export, natural hedge might not work.
In case of, if they were manufacturing in Japan and then selling from Japan, then they would have been exposed to dollar. And when they bring back the dollar and convert them into Japanese yen, and the yen appreciates, so they'll get fewer, yens for each dollar, like from 120 to 100, for example. So earlier they were getting 120 yen per dollar. Okay, if you suppose exposed to the foreign currencies like US dollar, and your customers are sitting in America and they are sending money, so you will get less number of yen per dollar as the yen has strengthened against the dollar. So that's why they adopted this strategy. Now we come to the second one, which is called diversification. Holding a variety of currency or positions to spread risk. Okay, instead of just exposed to one currency, you are holding variety of currency positions. Advantage: reduces exposure to any single currency movement. Use case: investors with global portfolios. So the investors which have global portfolios, so they are able to, they are also well diversified. Diversified example with USD INR. So let's understand one example. As hedging strategy involves spreading currency exposures across multiple currencies, reducing reliance on single currency, this minimizes the impact of adverse exchange rate movements in any one currency. So, instead of being exposed to one, you are exposed to many. So, it will rather reduce your losses or gains. So, you will be So, an Indian company imports goods from 3 countries, US, Europe and Japan. The company also exports its products to these regions. By diversifying its revenue and expenses across USD, Euro and Japan, the company reduces the risk of currency volatility in any one of these currencies. Is that okay? Imports, exports. So, these are some examples through which I have explained. So, they are having imports worth US dollar 1 lakh US dollar, euro, they are doing imports of 80,000 euros, Japan, so many Japanese yen. Similarly, exports, so their numbers for exports as well as for imports in all the 3 currencies are given. Now, the exchange rates are like this. For example, the current rates USD versus INR is 83 and Euro INR is 90, Japanese INR is 0.56, okay, and future rate is 85, 93 and 60. So, that means all the currencies have appreciated against the INR. The dollar has gone from 83 to 85, the euro has gone up from 90 to 93 and Japanese yen has gone up from 56 paisa to 60 paisa. Okay. So, if without diversification, USD heavy exposure. Okay. So, if you look at this, if the company had 100% of its imports and exports in US dollar, so imports in 3 months would have been close to about 85 lakhs and exports would have been 76 lakhs. So, that means their net cost would have been 8,50,000 exports minus imports minus. So, the full exposure to US volatility leads to a net cost increase. Okay. Suppose now we have diversification. So, here the import cost would be 2 crore 19 lakh 40,000. Look at the bottom line. So, we just multiplied the future rate 1 lakh with 85, 80,000 euros with 93 and yens into 0.6. So, it comes to 85 lakhs, 74 lakhs and 60 lakhs. So, if we add them up, it comes to 2 crore 19 lakhs. Whereas, exports, if we do that, it come to 2 crore 3 lakhs, okay, which is $90,000 into 85, 75,000 euros into 93. So, this is the rate, future rates, and Japanese yen from so many yen to 0.60. So, it gives you 57 lakhs. So, overall it comes to 2 crore 3 lakhs. So, total imports would be this and total exports are this. So, that means the net cost is 16 lakh 15,000. Okay. But here you will find that it has not reduced the expense. Okay. If you compare the two, without diversification it was 8 lakh 50,000, with diversification it was 16 lakh 15,000. Okay. Fine. So, impact of diversification. Although the total cost is higher with diversification, in this case it mitigates the concentrated exposure to US dollar. If the US dollar had spiked to 90 or more, diversification would have reduced the overall impact. Fine. So, it all depends upon how the currencies move. So, as per this example, if suppose the dollar would have appreciated much more than what we have shown here, so it would have resulted a lower cost compared to what we have seen earlier. Risk distribution, losses in one currency, INR depreciating against USD might be gains offset by gains in other currency, that is euro and Japanese yen. Suppose that is the case, but in our example everything has actually gone up, but it can be in actual situation that the currencies move up in opposite way and it can protect and diversify your exposures and reduce your exposure. The company's exposure is spread across multiple currencies, leading to more stable financial performance over time. So, now I am going to show you an example where the currency risk has actually benefited. Okay. So, currency correlations and diversification in hedging. So, there is something concept called correlation. So, I think some of the students had by the time joined and most of you have joined later on. So, the correlation is what? The correlation hovers between -1, 0 to 1. Okay. That means if the two assets, for example, I was just telling there was somebody called Harry Markowitz and William Sharpe way back in 1940s, an American economist. They got Nobel Prize for their developing a modern portfolio theory, which is based the fundamentals of today when we invest our money in various kinds of assets. So they said there are a couple of things learning from that theory was that, the assets, if you invest assets which are not correlated to each other, you are going to reduce the risk, number one, and improve your profitability. Okay, fine. Have you done the modern portfolio theory anytime?
Capital asset trust model. No.
नहीं, उसी से बनी हुई है, but modern portfolio theory. Okay, I'll show you a Excel sheet where I have shown how it benefits. There's something called efficiency frontier. Okay, so all the time we always think that where I should invest my money, which is the best kind of a portfolio which should give me the maximum returns. Okay, but by reducing my risk. Of course, if you take more and more risk, chances are that you may make money. But the idea is that can I reduce my risk and still make a huge amount of money? So these gentlemen, they were working on this theory and they came up with a mathematical formula ultimately. Okay, and they developed a formula and showed that by way of investing in such a way, you can actually improve your profitability by lowering your risk. Okay, so the one finding, I'll just show you that how done. I've explained that through and they made a chart, a graph, and on that graph there was an efficiency frontier, which means that if you invest your money in anywhere on that graph on the efficiency frontier, you will be actually always better than investing in any other form. Okay, so it all depends how much risk you can take. So if you take the minimum risk, it will give you some return. But if you keep increasing your risk, the returns will multiply. Okay, but it will come with additional risk. So they came up with this thing that a particular portfolio, which is called the lowest risk and maximum profits. Okay, so they find a point in the efficiency frontier where they said this is the place where you invest your money in this portfolio. It will reduce your risk and give you the highest return. Highest return means for that particular risk. Okay, but if the risk goes up, the return will also go up. Fine. So that will actually reduce your the least this thing and give you the maximum return. So, when you first of all, let's just dwell on that. When you invest your money, how do you measure the risk? How do we measure the risk? Risk के measures क्या हैं financial में? कुछ पता है? Standard deviation and beta. There are two measures. Are you aware of that? There are two measures of risk in finance which are called the standard deviation and beta. Now, standard deviation is the total risk, because when we invest our money, we are taking risk. Now, there are two parts to that risk. One is called the market risk and other is called the company specific risk. So, when you put your money in a stock, you are taking two risks because you are exposed to that company. So, that company specific risk and the market risk because of the macro factors affecting the market. Okay. So, all that risk is captured in standard deviation. That means the volatility of how the stock moves, Fine. How volatile is the stock while it gives you a return? More volatile the stock from the average, from the mean. So that means the stock is more riskier. So which means it will throw higher standard deviation. Suppose if I say, is there marker hai? Okay. For example, let's say there is stock X and stock Y. Okay, fine. Now, stock X gives a 20% return. So, this is the mean return, say over the last 10 years. When we always say that, over the time we always gravitate towards the mean return of a stock. Okay. Now, stock has given 20% on an average over the last 10 years. Sometimes it has given 5%, sometimes it is given negative 10%, sometimes it is 30%. So, average is 20%. So, that means stock is destined to give you 20% if there is no change, fundamental change in the stock, okay, because they are doing the same business, and suppose the Y has given you say 10% return, fine. So, if we have to select one stock, definitely we will say which stock? X, because it gives you a higher return. But then I just add another figure which is called the standard deviation. How volatile is the stock X? Suppose the stock is 20% volatile, fine, and this stock is just 5% volatile. Fine. Or just say, let's say only 2% volatile. With no volatility, hardly any volatility. ये 10% ही देता है हमेशा, कभी 10, 11, 9 के आसपास. Suppose, let's say. So now which stock to invest? So what we do is that we take the return divided by standard deviation. So this gives 1. Figure of 1. Okay. So this is risk per unit of return. So this is giving a return per unit of risk. Sorry, return per unit of risk. And this gives you what? 5. Here you are getting 5 returns per unit of risk, which means that this stock is giving a higher return per unit of risk. So here you take less risk, but you still get 10%. Fine. Now, if suppose you have invested and with this stock X, and say in 2025, and in this year it has given you minus 10%. So you will be very unhappy about it. Though the stock long-term average is 20, but it has given you minus 10, isn't it? So you are not happy. So, but in this stock, suppose if you are invested in Y, it has given you say 9.5%. So the average is 10, so you are still happy that it has given you 9.5%. Okay. So all people have their own risk profile. Some people say I will prefer this. Some people will say, okay, I'm going to invest for a long time, so I may get the mean return over the long time. Is that okay? Fine. What's your good name? इसको सुनना बड़ा important है. Are you meditating or what? Okay. ये बड़ा important है. So, unless if you don't want to put your money in stock market. Okay, now, so the standard deviation is actually a measure of volatility. Okay?
Basically, it's a division between short term and long term, right?
No, I'm not saying that. Okay, just hold on with your thought at the moment. So I'll just telling you long back about 2010 or something or 8, when I started investing. Of course, I was investing in 1992 at the time of Harshad Mehta, but in big way I started, putting my money in stock exchange in 2007, 2008. So the first stock which I, chosen was Maruti. Maruti was trading at 1,000 rupees that time. Okay, and today it's 10,000. Okay, 11,000. So what happened was, after a week, I had invested 1 lakh rupees. I bought 1 lakh Maruti shares, 100 shares or something, whatever. And after a week, there was a strike in Manesa. There was some death and Maruti was locked out. And the stock came down to 500. So my 1 lakh became 50,000. So that was the company specific risk, which actually made me to lose 50,000 within a week time. So that's called company specific risk. So I told you that risk is total risk, which is actually measured by way of standard deviation, which is company specific risk plus the market risk. So these are the two kinds of risk which I take. Because of this risk, I lost how much? 50,000, 50% of my money. Had I invested my money instead of 1 lakh in Maruti, I had invested say in 20 stocks, Reliance, Infosys, everything, I would have not lost money. Because some stocks would have gone up or come down because of the company specific. So I would have eliminated the company specific risk by making a portfolio. Okay, by putting my money by diversification. So through diversification, you can eliminate the company specific risk, but you will be left only with the market risk. Okay, and the market risk is measured through beta. So instead of just focusing on the standard deviation, if you are invested in a portfolio, you invested on beta. So there are high beta stocks, low beta stocks. Only the relevance comes when you are well diversified. Okay. Now, what is the beta? For example, if the Sensex or for example Nifty or anything, Sensex, let's take, if the Sensex goes up by 10% and your stock goes up by 20%, the way you have invested, so beta will be 2. Return of the stock divided by the return of the market. Or if the Sensex goes down by 10%, your stock will fall 20%. So beta is 2. So they are more volatile compared to the base, which is the market. Similarly, if I say the stock goes up by 5%, the market goes up by 10% and the stock goes up by only 5%, or the other way around, what is the beta? 0.5. So company like Hindustan Unilever has a beta of 0.5 because it is present into a business which is called FMCG, where the consumers are going to buy their products, whatever to happen to the state of the economy. Okay. Whereas if you buy a stock of, for example, a Mercedes car company or a Honda company where the beta is 1.5, so those companies will do only well during good economic times. When the economy is doing well, those stocks are going to actually give you a higher return than the Sensex. So they will have a beta over 1. Okay. So they are manufacturing products which are consumer discretionary. That means we use our discretion to buy those products. In good times, we are going to buy their products, so the beta will be high and will get higher return. So if you think the economy is doing well, then you should be putting more and more money in high beta stocks. If you are thinking the economy is going down and a stable economy, then you should hide yourself into stocks like FMCG and other stocks which are going to protect your portfolio. But at any given time, you should have a well diversified portfolio of stocks in various kinds of categories, high and low beta. Okay. So
This is the beta is a risk here, right?
yeah.
So, but why are we dividing the returns? Shouldn't we divide the standard deviations?
No. Just understand. What's your good name?
Ankit.
अंकित एक्चुअली हमने क्या करा, रिटर्न लिया, उसको स्टैंडर्ड डेविएशन से डिवाइड कर दिया. तो दैट मीन्स रिटर्न पर यूनिट ऑफ रिस्क. एक जगह रिटर्न है, एक जगह रिस्क है. आपने रिटर्न को रिटर्न डिवाइड करा रिस्क से, तो इसका मतलब आपको आ गया कि एक रिटर्न, एक यूनिट, 1% रिटर्न कमाने के लिए आपको कितना रिस्क लेना पड़ता है. तो दिस इज अ मेजर ऑफ हाउ मच रिटर्न पर यूनिट ऑफ रिस्क यू गेट. I am talking about standard deviation is the total risk. Okay. Now we can do also return divided by beta also, if you are invested in portfolio. Okay.
My question was, what is beta? Beta is, you said, return of market divided by return of.
No, beta is risk. Beta is a measure of risk. I think this is a formula to calculate the beta, which is taking the return of the stock, return of the stock divided by the return of the market. दोनों में return लिया था उसके अंदर. The thumb rule is, of course, this is not the ideal formula for calculating the beta. This is a thumb rule कि आपको अगर beta निकालना है. Otherwise, to calculate beta is little formula is something like covariance formula is there. Okay. Covariance divided by standard deviation. Okay. So I'm not going into that. Okay. I'm just saying a small shortcut method is take the return of the stock divided by the return of the market. Then you get approximate beta of the stock. Okay. Fine.
But sir, here everything depends on the time span. For example, आपने मारुति का एग्जांपल लिया, अगर आपने अभी तक होल्ड करा होता तो 9,000.
आपने
अभी तक होल्ड करा होता तो 9,000 रुपए का शेयर था.
हाँ, अभी तक 9,000 का. अगर लॉन्ग टर्म के लिए देखो क्या होता है कि दैट वाज ओनली अ 1 वीक काइंड ऑफ अ फिनोमिना. बट इफ आई हेल्ड विद द स्टॉक, ऑफ कोर्स आई हेल्ड विद द स्टॉक, टुडे आई एम हैविंग इट एट 11,000. ओके. Still it is in my portfolio from that time. I never came out of Maruti. I lost the money. It was an unrealized profit which I made, but then unrealized loss I made, but now I am sitting on a profit of that. Okay, fine. Is that okay? That is what your question? नहीं.
पूरी कैलकुलेशन में सर टाइम स्पैन सबसे बड़ा फैक्टर है ना.
हाँ, टाइम स्पैन सबसे बड़ा फैक्टर है. दैट इफ I told you that the average return of the Maruti is say 15%, the mean return. It will give you 15%. In that particular year, it gave you negative 20% return. Fine. So if you are invested in equity market, it's not a game for 1 year, it is a game for next 5 to 10 years. So remain invested and you're going to be patient, you will get your return. Okay. अब आप एक वीडियो मैंने आपको शेयर करा वो वॉच कीजिए उसमें. Okay. So in a particular 1 year time frame or 6 month time frame, the stock market may go down. That's the nature. But it was just to explain what is the company specific risk and the market rate. It was just an explanation, nothing else. बाकी आपका डिसीजन है इसको कितना होल्ड करो. Is that okay? So now, I told you that the stock has a standard deviation or a beta which measures the risk. Okay. Now there's something called correlation. So first he said that okay, if you're going to invest your money into risky stocks, okay, and if they are not correlated to each other, it is going to reduce your risk. So that was basically the theories. This thing. Should I show you that Excel sheet where I've worked? So it's called efficiency frontier. Okay. So this was basically a theory given by the Nobel laureates like Harry Markowitz and William Sharpe. So just I'm going to spend only 5 minutes, not more than that, because that's another topic. Okay. Now think about two stocks, stocks A and B. Now here's, this is a very simple example that your portfolio consists of only two stocks. You can keep increasing the number of stocks and apply the same formula, you will get the result. For a two portfolio, the calculations become very simple. Now the stock A has a 15% return and stock B has 20% return. Okay. The standard deviation is 25% and 40% for both the stocks. And the correlation is 0.2. It can hover between -1 to 1, as I told you. Suppose the stocks have low correlation. Okay. We can always change the correlation here. It's all Excel sheet driven. I'll share the Excel sheet and you can keep finding out the returns. Okay. This formula. So, and on the right hand side, we have the efficiency frontier. Okay. So this is the efficiency frontier, which is telling you how much return you will get by investing what kind of a mix of the two stocks. Suppose you take 100% of stock A and 0% of stock B. So what is the return? 15% and risk is 25%. Is that okay? आपका रिटर्न 10% है, रिस्क वहीं का वहीं है, ए वाला. अब आपने क्या करा, आपने सेकंड केस में पोर्टफोलियो में 90% ए डाल दिया और 10% बी डाल दिया. आपका रिटर्न कितना हो गया? 15.5%. Okay? Because 90% is giving you 15% return and 10% is giving 2. So you take the average and the return will come to 15.5%. But the standard deviation falls. This is not just an average. Standard deviation निकालने का अलग formula. This is based on the correlation of the two things. The lower the correlation, it will fall further. Like for example, it is 23.63. So suppose I say it was stock correlation was 0.1. Just watch for this standard deviation here. It was 1. So it will go to further down 23.24. Okay. And here it was 23.63. तो जैसे जैसे correlation कम होता चला जाएगा, आपका risk कम होता जाएगा portfolio का. That is what the message they gave. Okay. Suppose I say it is minus 0.5. Okay. What happens? और नीचे चला गया. So let's go back here. So now 90% stock is A and 10% stock is B. And standard deviation is 23.6. So as you invest more into the stock B, which is a higher standard deviation, more riskier, but because of the correlation, the total risk is going to fall. That is what the message came from those people. And then he said, if you want to make 69% and 31%, now this was called the best portfolio. He calculated through a formula. If you invest 69% in stock A and 31%, there the return will go up to 16.5. The return is going up and the standard deviation falls to the lowest, 23.2. And thereafter, any mix of B, the standard deviation is going to go up and go to 40%. When you have 100% of B and nothing of A, then the risk is 40%. Is that okay? Fine. And now what I can do is I can just change this. Suppose I say I have invested in assets which are not correlated to each other at all. Then the risk will go down to the minimum, which is 4.59%. And return goes up to 16.57 here.
So you have put 0 in correlation?
Nahin, -1. Suppose you have invested your money in the two assets or two stocks which are not correlated to at all.
So when we say not correlated,
Correlation hai hi nahi.
that means they are inversely proportional to each other.
Absolutely. Just listen to it further and then carry on with your thought process. So what I have done is the return is going, the return as the standard, the return is going up, but the risk has fallen to only 5%. The risk falls to just 5%. तो अगर आपने दो एसेट्स में लगाया हुआ पैसा जिसमें कि परफेक्टली नेगेटिव कोरिलेशन है, you will, the risk is going to fall dramatically. That is what the message is, and the return is likely to go up from the earlier portfolio. यही था मैसेज उसका. Is that clear to you, or still it is some doubt? Just focus on what I am saying. आपकी thought process निकाल दो, इसी को सोच के देखो, आपको आंसर मिल जाएगा. Okay, is it clear to everyone? So then you look at this portfolio, this thing. This is the standard deviation. This is the risk. This is the return. So risk is becoming lower and lower. So it is bulging. It is becoming this thing. Suppose I say that it is like minus 0.5, then the risk is going up. Look at the efficiency frontier. The risk shifts. Risk बढ़ गया, okay? और risk कितना हो गया? 69 वाला 15.38, okay? And you can see the frontier here also. It is coming with more risk, but the return also goes up. So now it all depends upon, so if you choose the most So this was what the saying was, okay. So let's go back. I actually, I have got a financial planner, I have an advisor for me who comes to my house. He was, my relationship manager from last 30 years. He was Citibank RSM. And at that time, I was not knowing anything about the stocks at all. Today, I teach all that. So he's been coming to my place. I have retained him. And he's quite helpful to me. So, he talks about the same, the language of all the investment bankers is the same given by the Markowitz and William Sharpe. But the theory has lost its significance because it has a lot of assumptions, because all theory comes with a lot of assumptions. Sometimes those assumptions don't hold true, okay, fine. So when I will share you with the assumptions, you will find, okay, these assumptions, but their underlying concept was absolutely great. जो इसमें concept है जो आपको आया है, that's absolutely fine, that you should be investing in assets which are not correlated to each other, and the correlation can always bring down the risk. So the major findings of the theory, how you design that, of course he designed using the modern portfolio theory for me. उसने वही डिजाइन करके मुझे पोर्टफोलियो में बनाया कि यहाँ पैसा लगाना चाहिए, okay. But then you have to have the essence of the theory and apply that. And if you understand the theory, then you will understand, how your relationship manager has designed your portfolio. Okay, fine. Okay, is that okay? Now currency diversification relies heavily on the concept of correlation between different currency pairs. Now, similarly, because you are making your investments in various kinds of assets, various kinds of currency. You are investing in US, you are investing in Japan, you are investing in Europe, okay, as an investor, or you are doing your business by having your various facilities everywhere. You are exposed to all the currencies the same way. So if the currency correlation is in your favor, that means they are not correlated to each other so much, you are going to maximize your losses, or you are going to maximize your gains. Okay. Understanding how the currencies move related to each other helps in designing an effective hedging strategy. Positive correlation, +1. Currencies move in the same direction like US dollar and Canadian dollar. They have virtually a +1. Negative correlation, currencies move in the opposite direction like US and Japanese yen. Of course, this is over the time. Okay, fine. So there's something called dollar index, which I'll just share the concept of that shortly. Zero correlation, no relationship between the movement of two currencies. Okay, fine. So this is the currency correlation. Now example, just let's complete this example, then I'll show you the dollar index. The US dollar versus INR and US euro, there's a moderate correlation. They generally move together, but not perfectly. USD INR and Japanese INR, inverse relationship. When USD rises, Japanese yen often falls. Now take a Euro INR pair versus the Japanese INR pair, -0.5. Here also the stronger negative correlation moves in the opposite direction. Like the US dollar and euro are also, have a positive correlation, but not that much. So that's why here the negative correlation is not as compared to the US dollar versus Japanese yen. Okay. How correlation affects diversification? Just read this. Anybody? आप पढ़ेंगे? कौन पढ़ेगा? आप पढ़िए.
High correlation risky for diversification. If two currencies, example USD and Euro, are strongly correlated, diversifying into both provides little protection. If INR depreciates against USD, it is likely to depreciate against Euro as well, amplifying the loss. Then these are examples that USD INR 83 to 85, Euro INR is 90 to 93, Japanese yen to INR is 0.56 to 0.60. In this case, the company faces losses in both USD and Euro transactions, limiting the effectiveness of the diversification.
Okay. So, yeah. So, if the two currencies, for example, USD, Japanese yen, have negative correlation, losses in one currency may be offset by gains in the other. For example, USD INR 83 to 85 and Japanese yen moving from 0.56 to 0.52. In this case, the loss in USD imports is partially offset by lower Japanese yen import cost, stabilizing the cash inflows. Okay, because you're seeing that the dollar has appreciated, whereas the yen has depreciated against the INR in the same period. Okay. So let's now look at an example using correlation, import breakdown. Okay, this is the export breakdown. So we apply these numbers, strong correlation versus USD versus INR and euro. So export round, so net cost is 13,30,000. If you are exposed to two currencies which are strongly correlated, the net loss was 13,30,000. That means this much of there's a gap between the two currencies. Then if you has a mixed this thing, that means USD versus INR and Japanese yen versus INR. So that means the total cost will come down here, 11,30,000. Okay, because these currencies are not mixed correlation. So scenario 1, strong correlation, higher net cost because INR depreciated both USD INR. Strong scenario 2, diversified with Japanese yen, lower net cost as INR appreciated against Japanese yen, offsetting the loss from US appreciation. Okay, is that clear? So now you can just read through a slide because you understand the concept. Okay, now the numbers you can always find whether the maths is working and how it is working. Yeah.
Sir, how we can find out कि which currencies are correlated and which are not? Like Euro USD, they are.
हाँ, अब क्या मैं आपको बताता हूँ. देखो मैंने अभी क्या करा है, आपको एक एक्सेल शीट भी भेजी है, तो हम उसको देखते हैं. What is that? IIFT. So hedging currency risk, there is a Excel sheet. So so correlation. Now what you have to do is that it is of course all these numbers you can always get through this thing. You can search on a chat GPT, it will give you that what is the correlation between the currencies presently. Now if you want to do it yourself, so you take the this thing. Now this is basically 23 data, full year, January, February, right in the midnight, March, April. So all this information is there. So you have the USD versus Japanese yen and USD versus Japan. Okay, all the numbers are there. Okay, so USD versus Japanese yen and USD versus euro. Okay, then you look at these movements. Okay, इसमें movement दी हुई है कि डॉलर जो था, डॉलर वर्सेस जापानीज येन हैज एक्चुअली मूव फ्रॉम 130 to 132, then 129, then 128 every month. Now it is 136. Okay, similarly euro versus the USD. So that's a pair. So this is how it has moved. So that means one euro is equal to how many USD? Okay, fine. So then you just calculate the change and divide by both the changes you look at. Okay, for example, if I just show you the formulas here, so it tell you basically that एक महीने का दूसरे महीने का डिफरेंस ये आ गया और उसको हमने डिवाइड करके ले लिया. Okay, so similarly then you can use this formula called correlation here. Okay, so correlation जो है कैसे निकला हुआ है? Correlation is done through by a formula here. This is here, which is basically you go to the Excel sheet and go to the formulas and look for correlation. Go to the statistical formula, you'll find the correlation there. Then you just choose the the arrays, array 1, array 2. आपको यही चूज करना है यहाँ पर, और यहाँ चूज करना है ये. Okay, and then enter. So you will have, sorry, I think I've chosen wrong. हाँ, पहला blank वाला भी choose कर लिया था वो. I think that is a mistake. So इसमें क्या करा है? इसमें आपको, अब हम इसको ये देख लेते हैं. तो इसमें ये चूज करा हुआ, हाँ यहाँ से करा हुआ. मैंने आपको ऊपर सबसे टॉप से ले लिया था. तो दोनों चूज करके कोरिलेशन निकाल दो. तो कोरिलेशन कितना आ रहा है? 0.36. So you get a 0.6. So it will hover between -1 to 1. So this relationship between the USD Japan currency versus the Euro USD currency, what is the correlation between the two pair? The pair is 0.36. Okay, so this is the way how it is calculated. हाँ, डेटा पे डिपेंड करता है. आप पिछले 3 महीने का डेटा ले लो, if you are trying to find out the correlation. Okay, now if the things have changed dramatically, then you should the correlation will change over time. Okay, so you have to just be very very this thing that choosy about what period you are choosing. अगर आपने एक जैसा पीरियड लिया, होमोजेनियस पीरियड लिया, तो आपको अच्छा कोरिलेशन मिल जाएगा, परफेक्ट कोरिलेशन मिल जाएगा कि क्या है. और उस टाइम में अगर सपोज देयर वाज a lot of volatility in the world markets. So for example, I'll just show you here, okay. अभी आपका है भी ब्रेक कितने बजे है? अभी टाइम है? अच्छा ठीक है. Dollar index. So this I'll just show you the dollar index. So there is something called dollar index. This is very important, okay. Just focus for another 5-10 minutes, okay. Dollar index. Have you heard about dollar index? Anyone? What is the current dollar index? Dollar index has moved back to 108. So the dollar index was started a few years back, maybe around 1973. US dollar index, which is called USDX or DXY, measures the value of US dollar relative to the basket of 6 major currencies. Okay. Euro is 57.6% of that index. Japanese yen is 13.6. British pound is 11.9. Canadian dollar is 9.1. Swedish krona is 4.2 and Swiss franc is 3. So there are about 6 currencies on which the dollar index has been formed. Okay. So established in 1973, the dollar index reflects the dollar's performance against these currencies with a base value of 100. It started at 100. Suppose if the dollar index goes up, that means the dollar is appreciating against all the major currencies of the world. If it's the other way around, okay, a value above 100 indicates stronger dollar compared to the basket, while the value below 100 signifies a weaker dollar. Now, if the dollar keeps going up and the dollar index rises, it becomes very bad for the world. It happened about in the Ukraine when the war started. So it went up to I think 112, 113, where it led to a lot of inflation in whole of Europe, everywhere, because in dollar terms everything was becoming very expensive. So if some of the relatives are staying abroad, they'll tell you the things have become very costlier after that period, okay, and it has hurt their economies. Germany came into recession, but then the dollar softened. It came to about close to 100 and 101 just before the announcement of the results that Trump has won. Now after Trump winning, it has again started shooting up because he's making a lot of noises, okay, and which is affecting the markets. Economic indicator. The US serves as a barometer for the US dollar strength in the global market, influencing the international trade and investment decisions. Impact on commodities. If the dollar index goes up, the commodities become very expensive. Everything becomes very expensive, which is basically the major source of producing all your goods. Since many commodities are priced in US dollars, okay, strong dollar can make commodities more expensive in other currencies, potentially reducing the demand. Investment decisions. Investors and trade monitors the USD to inform, monitors the index to form strategies related to forex trading, hedging and assessing the potential impact on multinational companies' earning. Fine. Movement over the past 1 year. As of December 2024, the dollar index has experienced notable fluctuations. Late 2023, the US dollar was trading at 102. When the Ukraine war, the Japanese yen has actually depreciated most about 25% in that period. India was largely insulated. We were originally very firm, and then we also depreciated about 7 to 8%. Okay, because during the COVID time, what had happened was a lot of people had come with a lot of policies of throwing money at the people. Okay,
The US economy
so there's a lot of money supply in all over the world, whereas India has actually not given money in the hands of the people, or gave only ration to the hands of the people. पैसा किसी को नहीं दिया था तो बोला हम लोन दे देंगे आप वापस कर दीजिए. Whereas all the money and all the industrialists, like Rahul Bajaj and other people, many industries, they're saying that, or even as a economist, they were saying some money should be given to the people because people are suffering, but the government didn't do that. What happened thereafter was that all the countries in the world, they experienced a huge inflation. The American inflation went up from almost 1% to 4.5% to 5%. Everywhere the inflation had gone up. India was largely insulated. Okay, and all the economic indicators, high frequency indicators at that time and today are very good. Okay, there's something called PMI. Have you heard of the PMI? Purchaser Manager Index. That's a very important thing. I'll just show you that later on. So the Purchaser Manager Index currently for India is about 57, 58. which tells you anything above 50 is good for the country. That means the country is progressing, which actually tells you about the production, the employment, and the sales. It captures a lot of numbers of the economy and makes an index. So if it is below 50, then the economy is contracting. If it is above 50, the economies are doing fine. So we have been above 50 and rising for last 3-4 years. Whereas all other countries in the world, they have been experiencing a fall in the PMI going down to below 50, and now they have come out a little bit, okay? They have touched 50 or gone above, okay? So,
So this PMI is same what is called manufacturing PMI.
there are two PMIs. One is called the manufacturing PMI, and this is called the services PMI. This is actually, on the every first of the month, it is published for all the countries of the world, maybe 170, 200 countries. So it publishes for all the countries of the world, and it is published for both the manufacturing, services, and a composite PMI, which is the combination of the services and this thing. Okay, you know that during the 2008 when the stock market fell down, Indian market from 22,000 to 8. Similarly, the Dow Jones fell down from somewhere to 8,000 or whatever. At that time when it fell down to the lowest level, at that time the PMI showed a signs of revival, and the market thereafter revived. From 8,000 index of Sensex, it went up back to about 14,000-15,000 within a span of about, because it captures the production, the sales, the employment. So, they find out that, all that packing material was showing an up move. So that means people were manufacturing more of packing material, which was a sign that, things are going to be, they're ready for dispatch of the material. So the PMI showed that the PMI had slightly inched because the packing material, और जिसको बोलते हैं पन्नी बोलते हैं, मतलब प्लास्टिक की जो है, वो वाला फिगर एकदम ऊपर चढ़ गया, और उससे पता चल गया कि revival is on the card. Okay, 2024, just read this yourself. So December 24, the US dollar has risen approximately 5% since the beginning of the year, reflecting the US economy's relative strength and interest rate attracting foreign. Okay. So अभी टाइम कितना है ब्रेक का? होगी, चलो ब्रेक करते हैं. अभी है या खत्म हो गया?